everyone, welcome back to my channel. In today's video, we will learn some basic accounting terms that every commerce student must know, especially if you are in grade 11. So let's see. So, like the other, accounting also has a language of its own, and to understand this language, we need to learn some basic terms. So, accounting terms. These are the basic words used daily in the business world to record, explain, and analyze financial activities. So, these accounting terms are also known as accounting terminology. So, let's go through them one by one. First, we have entity. An entity is an economic unit. It can be business entity or non-business entity. First, let's see business entity. Its goal is to earn more and more profit by sale of goods and by providing services to the customers. For example, a business entity can be Maruti Suzuki, Hyundai, Samsung, etc. Second is non-business entity. So its goal is to provide services to people, not to earn profit. For example, charitable hospital, public libraries, etc. Next we have business transaction. So it's any economic activity that changes financial position of a business. For example, buying goods and selling products or paying wages. So let's see to the main features of business transaction. First is it has dual aspects. It means if one side is debited, then another side is equally credited. Second, we have that it's an economic activity dealing in money, like by sale and purchase of goods. Third, every business transaction is those which can be expressed in the terms of money. Next is account. So an account is simply a place where all the business transactions are recorded in the books of account. Next we have capital. So capital is the amount the owner or proprietor invest in his business, or owner start his business by investing capital. It can be in form of cash, goods or assets. The formula is capital equals to assets minus liability. Next we have drawings. So when owner withdraws money, goods or asset from his business for his personal use, it is called drawing, and this reduces the owner's capital. Next we have liability. So liability is the amount that the firm owes to outsider. It means it has to pay to outsiders in future. It is created when business purchases something on credit. So liabilities are of two types: internal liability and external liability. Internal liability, which the business is payable to its owner, okay, because he invested the capital in the business. Next we have external liability. These are the liability which a firm is payable to creditors or bank, okay. So external liability is further classified into two parts: current liability and non-current liability. Current liability, which the firm is liable to pay within 1 year or within one accounting period. Second is non-current liability. So these are the liability which a firm can pay after more than 1 year or within a long time period. Next is assets. So assets are the property of the business which a business use, okay. For example, machinery, furniture, land, building. It is of three types: current asset, non-current asset and nominal asset. Current asset, which gets converted into cash within 1 year by selling them. For example, stock and debtors. Non-current asset, which gives us long-term benefit and they are not for selling purpose. Like they are tangible asset and intangible. Tangible asset which can be seen or touched, like land and building, and intangible asset which can't be seen or touched, like patent, goodwill, and also we can write honesty of employee and manager. Third, we have nominal asset, which is also called fictitious asset. So they don't give a direct benefit, but they are too recorded in the books of account, like trading and profit and loss account. Next we have expenditure. So expenditure is the money spent or liabilities incurred by a business to acquire goods, services or assets for earning revenue or running operations in the particular business. So it's of three types: capital expenditure, revenue expenditure, and deferred revenue expenditure. Capital expenditure, so it is the expenditure done on fixed asset, okay, that lasts for more than 1 year. For example, we spent to buy a fixed asset like building and machinery. Second is revenue expenditure, so these are the expenditure done on the daily basis on day to day operations like wages, rent and repairs, okay. They helps in generating revenue within the same year, okay. Next we have deferred revenue expenditure, so these are the large expenses like heavy advertisement cost that are paid once but gives us benefit for many years. Next we have capital receipt, so capital receipt are non-recurring amount that a business receive. These are not regular incomes, but they either create a liability like a loan or reduce an asset, like when fixed assets are sold. So, for example, loan received is the example of creating a liability, and sale of fixed asset is reducing an asset. They don't affect profit directly, but they are more related to the capital or structure of the business. Next is revenue receipt. So these are just opposite to the capital receipt. These are recurring amount received during the normal operations of the business or on the normal course of the business. For example, sales, interest or commission earned. Since they are a part of regular income, so they do affect the profit directly. Next is expenses. So expenses are the cost that a business incur in producing or selling of goods and services. This could include raw material cost, electricity bills, salaries or advertising. In short, expense is the money spent to earn money, okay. Next we have income. So what is income? It's the amount left after subtracting expenses from revenue. So let's break down. What is revenue? Amount received from sale of goods, and expenses, cost of sold goods or selling those goods. So therefore the formula will be income equals to revenue minus expenses. Next we have profit. So profit is the excess of total revenue over total expenses in a business during a particular accounting period. So let's take a small example, like total revenue is $50 and total expenses are $43. So simple formula is profit equals to total revenue minus total expenses. So profit will be of $7. So now let's see gain. So gain is a kind of unexpected benefit or advantage from events or transactions. It's something that a business didn't plan for, but they are happy to have it. For example, getting a tip from a customer or earning extra commission. These are no rule or compulsion to gain. It just happens incidentally. Next, last we have loss. So loss, it is occurred when total expenses exceeds total revenue. In profit, we saw that total revenue over total expenses, but in loss, it is total expenses exceeds total revenue, and it gives no benefit to the firm. It is also incidental. For example, loss due to theft, loss due to fire and accident, etc. So that's all for today. These basic terms will help you to build a strong foundation in accountancy. If you found this video helpful, don't forget to like, share, subscribe for more such lessons. Also drop any topic if you want us to explain in the next video. Until next time, happy learning.